Bill, what is happening, buddy?
Not much, man. Glad to be back here.
Let's do it, man. It's like we're teaching a class, right? Is that how you feel?
I've kind of come from a long line of teachers, and we did this, like you mentioned in the past, we did it for our team, and it was fun. I mean, I enjoy doing this. Again, some of it may be very rudimentary to some people, but hopefully it hits, some portion of the audience who is just trying to figure all this stuff out, stuff they didn't learn in dental school.
That's right. I mean, we're teaching a class. The question is, do we have any people attending,
Yeah,
right?
hopefully so. Yeah,
Um,
yeah.
but no, this is good. I mean, just kind of continuing our series, and if you guys are listening to this, go back and listen to the last couple because they're building on each other, right? But just unpacking the all team educational deal that we did in person here around our 10-year anniversary, and kind of going back, going over the speed financial statements again. If I say speed financial statements, and you're like, what is that? Go listen to I guess the
Mhm.
two previous to this one, and then big high level. Last time we went over the three, or I guess four, right? Big questions,
Yep.
to kind of ask yourself as you're diagnosing your dental practice. So again, if you don't know those four questions, go back and listen to that episode as well. So today we're kind of going to dive into that first question. Now, I hope you guys have your speed financial statements with you, or at least some production data here you can kind of take away, or can look at afterwards. Maybe you listen through this episode, but we're going to really just unpack that first question, Bill, which is, do you have a production problem, right?
Yeah, yeah, for sure. And so, kind of jumping into that and kind of drawing a correlation back to the speed financials. This is one of the first things, we taught new team members who weren't familiar with the dental industry is when we say production, for most people, that's not what's going to hit your P&L, right? That what hits your P&L is collection, which we'll be talking about next time. So, we started having to explain to people that this is a little bit of a more of an abstract concept that's not really going to translate directly to your profit and loss statement. Hopefully, it translates pretty close. We'll get into that again with collections. But, I think we have to start and almost back up to the beginning like, well, what the heck is production, right? Because there's different ways to look at it. And, I want just to take a real brief detour, Jared, if you'll allow me to say,
Yeah.
let's kind of talk through what we consider production that we want to track, right? And so let's start with gross production, which people have heard of. And then you have your discounts, your write-offs for insurance, things like that. And you get to net production, right? This was the training that we did with our team, is help them understand that gross is really kind of like the total potentially you could get prior to having to write off for your insurance and making discounts for friends, family, whatever else you might discount your services for, gets to that net production. And so from henceforth, anytime we use the word production, we'll try to qualify, but if we don't, just know we mean net production, because in our minds, Jared, gross is good and you always want to track write-offs. That's something we can talk about in a future episode, but trying to keep this super simple, we'll stay in our lanes and say, assuming your write-offs are okay, we just want to look at net production because at the end of the day, that's what you can get in the door through collections.
Mm-hmm. 100%. You're exactly right. And so that's great. Going forward, we're saying production, we're talking about net. That could be a separate, right, a separate episode where we're diving
Yeah.
into the adjustments and write-offs, and what you can do to try to increase that net off your gross. But yeah, I mean, if when we're talking production, we're talking net, basically what you can collect.
Right.
Fair.
Right. For sure.
Okay.
And, I think it's important because I've seen clients set goals on gross production for their doctors and they think they're crushing it, but they're not making any money because they're not factoring in all the write-offs.
Yeah.
So we are big believers, and the operators that we work with that are just killing it. They look at everything on net, and they do look at write-offs again because they want to see, is it getting out of hand? But can you see, like, if you set your goals for gross with a doctor without kind of reverse engineering back to a write-off percent, your P&L, your cost of goods sold that we'll get into later, that's not going to work, or it's not going to be as strong. So just something to be aware of. Most great operators we look at, when they're looking at these ratios, we're going to be talking about these metrics, um, they're looking at net. So we'll kind of put a pin in that and say, We are talking about net here. That's all we care about. So let's just dive in, Jared. So you and I are big believers in the old Jim Collins concept of zoom out to then zoom back in, right? That sometimes the best thing you can do is go up to that 10,000 foot view and try to figure out what's the lay of the land. What are we looking at? And so we've kind of worked through some, but the one we've kind of settled on, and I think the one we see our great operators really focusing on as that 10,000 foot view net production metric or KPI is net production per operatory. And that, in our minds, that's functioning operator, not potential operators, but the ones that are actually clinically set up, ready to go. What is your net production per month over the operatory?
Yeah, very, very simple calculation. If you guys are listening to this right now, remember what Bill just went through. It's basically net production minus your number of operatories in use, right? So go to your Dentrix, go to your Open Dental, whatever.
Yep.
Print out, right, your production report, if you will, for the trailing 12. Let's just do trailing 12 maybe. What is that net number, right? Gross minus adjustments and write-offs equals net. What is it? Let's use an amount. I'll just pull something out. $1 million. Let's say it's $1 million, right? Then divided by the number of operatories in use. Bill, that's a big disclaimer there that you mentioned, right? Let's say your office is, you've got 6 operatories, but you're only using 4 of the other 2. Maybe they're plumbed, but they're not furnished, right?
Yep.
You're generating $1 million of net production out of those 4.
Mm-hmm.
So do that math, 1 million divided by 4. That's the number we're looking at.
Yeah. And then if you take it down to a monthly total, then what we want to see is that number be somewhere between 25 and 30K a month per operatory. That's what we tend to see. A lot of offices that we see come in to us, they may be functioning 17, 18. That's a pretty common type number. Sometimes it's lower. Some we come in will be 35. And a lot of times if you're well above 30, that probably tells me there's some specialties in there. There's some things in there that are really high dollar production that you're able to do in a standard op. Because what's interesting about this number, this KPI that we're tracking here, is it also kind of is a capacity signifier. Mm-hmm. If you get up to 25 or 30, especially as you get towards 30, and say you're just a bread and butter standard dentistry, what we tend to hear in that is like, we are bursting at the seams. We just don't have anywhere to put people. And that is a good problem to have, I guess, but that's a situation where if you have those 4 ops and you're at 25 and you're really looking like you're bursting at the seams and you got 2 more potential ops that you can plumb out and get going, there's probably some good indicators that you have the ability to fill that additional capacity. So that's what's interesting about this one, is it tells us at a snapshot, generally speaking, are we producing what we should for the number of ops we have, but then also, are we doing okay for the space we've got to continue to produce well into the future?
Yeah, so let's riff off that example, and I'm going to just play with my calculator on the fly here. Yep. So that $1 million example, $1 million in net production over the last trailing 12 months, right? Divided by, in my example, I think I said 4 operatories, mm-hmm. right, that they're operating out of.
Yep.
So that's $250,000 a year per operatory. Mm-hmm. Divide that down to a monthly basis, right? Divided by 12, you're just a little less than $21,000 per operatory. So Bill, reference the metric you just said is a good parameter to go off of.
So generally speaking, we'd probably look at that and say decent practice, not a bad practice, but there should be some room to show some improvement, and anytime we hear people say, how can you do that? Right? It's not possible. We see people do it all the time, hit 25 and 25 to 30. So in that situation, we probably would say, okay, 10,000 foot view, we're decent, probably got decent profitability when we work through our P&L, but there's room for improvement. So what we would do, Jared, is kind of move on to the second part of our production analysis, which is say, okay, we've done our 10,000 foot view. Now let's also assess for a couple of other things. And again, this is kind of learnings we pulled from years of talking to our mentors, but then also just seeing great operators. We're going to look at production efficiency. Are our producers, and by that I mean associates or your doctor, if you're the doctor, and hygiene, are we producing, effectively? But then in conjunction with that, we also want to look at some KPIs for at bats, and then are we converting those at bats? Are we getting sufficient opportunities? If we have associates, are they getting sufficient opportunities? And if they are they making the most of those? So we see we're less than 25 and we're at 21, then yeah, there's probably some deeper dives that we can do, see where we need to shake out. So those are the next two steps. Is we're going to kind of check production efficiency, and we're going to check at bats and conversions.
Yeah. So let's do that. Let's dive down, right? We're at let's round. We're at $21,000 an opportunity per day,
Okay.
or not per day, per month. Let's go to that next phase you just referenced, right? So what do you want to go? Associates, or you want to go hygiene first?
I always start with the biggest driver of a dental practice is going to be the doctors or associates. And so this is something we hear all over. This metric is, they probably have heard it, right? We went to a conference and I presented this, and someone else said the exact same thing, is that if you have an associate, or let's say you're the doc, right? As kind of a minimum, what you want that doc to be doing is an average of 5K per day. That's really a good
Disclaimer,
number.
net production, right?
Net production, yes, per day.
Yeah.
Okay, you tend to find doctors who, are getting it done at 5K. Now, granted, someone who you invest time and money, this could be yourself. Again, we say doctors, this could be a solo doc that's the person listening. This could be an associate. If you are willing to invest in these folks and give them opportunities, including yourself, and give them opportunities, or give yourself opportunities to do higher dollar stuff, that number could be 6, 7, or 8K, right? So, what's really interesting on this, Jared, and this is where we had a case study in our example about you can't judge a book by the cover, because let's say you have multiple doctors, right? And let's say this number shakes out at 5.5 or 6K per month. And you're like, man, that's great. There's no room for improvement. We're good. This is where we'll always say it's always worth doing just a little bit deeper dive, even if your net production is 30K, just to see, is there anything that's out of balance? And in that situation, the case study we did, which was kind of based on a real client we've worked with, there was one doctor doing like 7 or 8K, and then the rest were doing like 4,000. And so just with a little bit of deeper insight, you realize it kind of averaged out to that 5 or 6K, but there were still 2 or 3 that could do better, that you could coach, mentor, whatever you need to do to try to get them up to that 5K. And then you just see that if you can kind of get all of your doctors up to that 5K, and then even if you have that rock star associate who's doing 7 or 8K, that's still going to be that rising tide, rises all ships, or raises all ships. So, that's just an interesting thing, is if you have multiple doctors, look at each doctor individually and see, even if your average, and again, we say to look at these as an average, but if your average is over 5, look at all doctors just to make sure they're all kind of at that baseline. So we tend to find if you can stick to that 5, you can have a pretty nice practice off of that.
Yeah. So just going back to the example, right? Pull that production metric, right? Production report from your software.
Yeah.
Production by provider, right? Make sure you can detail down, see where it comes from. Just look at the doctor production here. We're just looking at doctor production for the last trailing 12. Pull that amount right there. Let's just say you have 2 providers and two doctors, let's just say. So take the total, divide it by, that'd be for a month, for a year. Divide that down by 2, right? Because we're getting by provider, and then divide it by the number of doctor working days to see what you're at per month or per day.
And most software honestly has it. So you do a month view, excuse me, where you can see, what a doctor is, especially if you have analytics software. That's why I always like clients to have a Dental Intel, to have a Jarvis, to have a West Dental, or something that shows you on a monthly basis, so you don't have to do math. But yeah, it's as simple as that. And a quick pro tip we see great doctors do, especially if they have multiple associates, or great owners do if they have multiple associates, is set goals. Like, what do you want to do? And when we kind of get into how the cost of goods sold feature works with associate comp, you can kind of really incentivize them and motivate them to continue to try to learn to grow so they can drive that number up as high as possible and create a win-win for both sides. So that's the first one is we look at the associate and we really want them as a baseline doctor, associate doctor. Again, want this to be as open as possible for both solo practice owners and associate owners. Next, we want to look at hygiene. Again, we're focusing. This is a general dentist office, so we're going to have hygiene here, and what we like is that same metric: hygiene net production per day. Same exact calculation, except you're pulling the net production for your hygiene, and you're seeing what they're doing. We really want that goal to be 1.5, 1.5K, 1,500 per day. Could be 1,250. I've heard 1,250 to 1,500 per day, but almost without fail, we will see an office that's at that 21, 20K, 16, 17K per month total per op. There's almost always a deficiency in hygiene. It seems like this is one of the toughest things for folks to wrap their head around is the how do we get our people here. And the tough thing is that the supply demand curve is such that hygiene are able to demand more money. It's a supply demand, right? So this is something that if you are comparatively speaking to where you've been in the past, having to pay more for a hygiene, then the goals need to be set accordingly. And we need to really dive in and make sure we're getting that hygiene net production per day. This is one, Jared, I say we see it all the time. Sometimes we see half of that number. And those people are coming to us saying, how do I get more? I don't know how to do it. Is it possible? And what I can tell you is that we do see folks that are 1,500 plus.
Yeah. And today's episode is not like how to correct
Right.
that. That could be a whole additional series too, right? But you're right. That's what I was going to ask, Bill. What do you guys typically see on an average practice, if you will, on that per day? If you're trying to get to 1,250, 1,500, you guys seeing like 800,
Yeah.
750, 800?
Yeah, for sure. I mean, those are kind of very typical numbers. Good ones, even good clients, are good, relatively good operators. They're maybe 1,000. And, one thing that drives us nuts, Jared, is we're finance guys. We put metrics in front of people. We put KPIs in front of people. But at the end of the day, this is a function of your ops and your clinical team. And what I recommend is if you aren't hitting those numbers and you don't know how to do it, get help. This is something that we always talk about. If you have free cash flow, what do you do with it? Reinvesting back in your business and investing in a group that focuses on this. Fantastic. I would say that's typically money well spent. If you can find someone who can add $300 pretty quickly to that average per day, that's not insignificant. And I think it changes your mindset from hygiene being a kind of a loss leader or break-even prop at best to, we can do okay off of hygiene. And if you train them well, they also drive clinically to the doctors. It's a pretty virtuous cycle. So take the time to really focus on this. And I bet money people would see that there's room for improvement here.
Yeah, well, I would bet to say there's a lot of practice owners out there, and it's totally understandable. Business owners are busy, right? We're business owners, we're busy, but they don't know those metrics, right? It's exactly what two things, what they're doing now, provider or doctor, and then hygiene, but also what they're trying to strive for. They just don't have those kind of things in place. But let's kind of go back to the example a little bit, Bill. If you have, let's say we got this one doctor, 2 hygiene practice, right? 2 hygienists. And now this is getting it done. I think I would say, Bill, this is getting it done. If you take that 5K a day and then add 1,500 for another hygienist and 1,500 for another hygienist, right? 1 doctor, 2 hygiene. It's 8K net production per day. And let's just really annualize this at, let's just call it 16 days a month, give or take. Actually, I'm going to take that back. Let's do 8,000. And let's multiply that times 4 days a week, and let's do 48 weeks. So that's a $1.5 million practice.
Yeah.
And let's go back and riff off that same analogy still a little bit. I don't mean to play with my calculator all episode here, but divide that by 4 divided by 12, $32,000 per op, right?
Mm-hmm.
Now,
Yeah.
I'm not saying you can't just fix that overnight, right?
Right.
But that's kind of how it all builds to make all the metrics make sense. You're like, how do I get to 30? Well, that's the breakdown of how you get there.
Yeah, and as we go through this in fly, we understand people probably throw up their hands and say, "Well, we couldn't do that much in this number." We're just trying to make a point here that
Exactly.
is if you have 5K doctor producing per day, if you have 2 hygienists, let's say that's the golden solo practice ratio: 1 doc, 2 hygienists, 2 assistants, 2 front desk. Which we'll get into cost structure here in a couple episodes. But 8K per day, working 4 days a week, you can hit that 25K all day long. And that is one of those great practices that as a solo doc, it's the gold standard. I mean, you can make a fantastic living and do really well off of that. For group practices, this is going to be one of your portfolio leaders. I mean, I can just tell you, if you can do these kind of numbers, then when you kind of compare all your practices together, this is going to be one of the gold stars. And so it's just, again, I understand that these may be somewhat aspirational goals, but I can promise you, as a word of affirmation, it can happen. We see it happen, but it takes a lot of intentionality. It takes a lot of focus, and you've got to be able to operate well. And you got to be humble enough that if you can't do it, then you need to go find somebody who can help you do it. And there's a lot of good options out there. There's a lot of ways to invest some of your free cash flow back into the business to try to drive some of these numbers, because they will pay for themselves many, many, many times over. So those are probably the 3 great baseline production issues when it comes to true production, right? So if you're okay with it, Jared, we'll just move on to the kind of the underlying metrics of production, like what drives production. And again, are we getting sufficient opportunities for our hygienists, for our docs? And are we converting those opportunities properly? So the first thing we want to do there is we kind of want to look at the at-bat conversion KPI. Number 1, what we call the first metric we're going to track, KPI we're going to track for at-bats. And we like to see that as new patients. And what I will say there is, when I say new patients, we really want that new patients per doc. Okay. So if you're a solo practice, you got 1 doc, the number of new patients you have coming in is this number. If you have 2 associates, it's going to be the number of new patients divided by 2. You know what I mean? So you really want to kind of get it down to new patients per doc. And I think, what we've learned over the years, again, watching good operators, they like that number to be 50 new patients per doc per month. That tends to lead to good opportunities, because what we've learned over the years is new patients are the future revenue streams. That's what allows you to find people who haven't been to the dentist in a while, who have some needs, and you can treatment plan them. They may not accept it all. They may wait, but at least you have built out a treatment plan that you can try to get them to understand the importance of accepting it now, or if not, you kind of create the ability to have them in a pool that you can pull from in the future potentially. But 50 new patients per doc per month is what we tend to see there.
Yeah, people might have heard that and their mind kind of blown a little bit, like, what, are you kidding me? And I think I've heard this might be wrong, me saying this, but the average practice, to a degree, and I don't mean average in a bad way, but the average dental practice is roughly around 25-ish new patients a month, give or take. I believe that's right.
Yeah. I mean, and some are lower, some are higher. What's beyond the scope of this? I mean, we're talking keeping it simple again, new patients. But how many times have we seen, if you really truly look at new patients and then you look at attrition, they're actually in a hole. Patients are falling out. I think most software tends to be like, if they haven't had an active appointment in 18 months, they fall out. That's an important thing to track too. Beyond the scope of this, again, that's kind of business and dentistry 102. That's kind of in the future, but that's something to consider. If you're seeing a lot of attrition, then there's something with your recall, reappointment, those kind of things that you may want to look into. But again, we try to keep it super simple here, Jared, on this series at least, and start with new patients and focus on that side of it. And if we can get that 25, 17, 20, 25 up to 50 per doc, then you tend to have good opportunities to hit those production metrics of 50, or 5K a day and 1,500 per day. So kind of in that same vein of, beyond new patients, we also want to have our current patients reappointing and coming in. So what do we want as far as open time? And this is really diving deep into operational metrics. And as always, Jared, we throw up our hands and we say, we're not operators. We provide metrics and KPIs and put them in front of people so they can have good data, make good decisions. But what we've heard is we really want that open time to be kind of around that 10% or less per month. That means that the appointments that are available are getting filled. There's not a lot of people sitting around twiddling their thumbs. When they're there, they're working. And that 10% also tends to allow for some space for same day treatment as well. So that's kind of what we tend to see. Really, our great operators really want that number to be is less than 10% open time per month on average.
Yeah, so it's kind of like that sweet spot, right? Like you said, it's less than 10% because we're providing dentistry and we're going, right? We're busy, but also there's room to add those 50 patients, right, on a monthly basis into the schedule, so they're not pushed out forever, right? You can start, treating them and getting them in the mix as well. So it's probably one that a lot of people aren't tracking, the percentage of open time. But what we say is, if you kind of go through this diagnosis, it's a pretty important one to see. And it'll tell the story of probably what's happening.
And I think what's so interesting is if you look at the totality of this series, we get into maybe some OpEx and we're talking operating expenditures. We look at like marketing. Well, maybe there's an opportunity to create an initiative to spend a little bit of our free cash flow on marketing to try to put butts in seats. These are the conversations we have with our great operators. They're watching that number. And, we can't sit here and say that there's not, cyclical nature to dentistry. In some months, it's going to be more than that. And the longer you do this, the more you're getting, your business acumen and your understanding the business of dentistry. Operators know that too. They may say either April, May, or, September, August, September, October are the worst months. They know what months they're probably going to be less than that. But generally speaking, they kind of know that this is where they want to be. And that's 10% is kind of where they like to keep that. So that's, a super simple one that's kind of telling you, those two really, new patients and that, are telling you, are we working when we need to be working? Are we filling our appointment blocks efficiently? And there's good initiatives you can build out if not. And so the final one is just the standard one everybody's heard, which is, the conversion component of the at-bats conversion, and that's case acceptance. We kind of talk to clients, ever since we've been in this business, and we talk to Mike Abernathy, he talks about this, that there's just a certain baseline threshold that as long as you have an existing patient, they're going to say yes because they trust you and they like you and they know that you have their best interest. So there's like a baseline, almost a permission to play. I don't know exactly that number. I think he said maybe it's in the 60s or 67 or something like that. You should default to. You should always get that without even trying. But I think our good operators are really striving for that 70 to 80% is kind of what they really want that conversion number to be. With the one caveat that sometimes you're going to have a doctor who is really dialed in, and their treatment plans may be much bigger. They may have numbers that are going to be a little bit tougher for patients to bite on. So their case acceptance may be a little bit lower. But generally speaking, if we're bread and butter, if we're PPO with maybe a little bit of specialty here or there, that 70 to 80% will tell us that we've got, folks that are doing a pretty good job of putting forth good treatment plans that patients like and are willing to accept. So that's the number that we kind of track there as far as the baseline of the conversion portion of that production side.
Is it pretty safe to say, Bill, that if I'm looking at those three last metrics, I kind of look at them like a pyramid almost. Those the last three, which is, basically the number of new patients per month,
Yep.
what your percentage of open time is, and then also your case acceptance percentage. Is it pretty safe to say if that you're hitting those numbers that you went through on those, you kind of go up the pyramid a little bit, it should increase your doctor, production per day, hygiene, and ultimately the higher number that you went over, which is the per op number.
Yeah, for sure. And to the contrary, if you're not hitting some of those numbers, it's going to be extremely hard to hit it. If you're bringing in 50 new patients, I would say most doctors that are listening, say if you're a solo practice owner, if we could say, hey, would you take 50 new patients per month? Your whole team is working 90% of their allotted appointment times and efficiently, and we're converting on 70 to 80%, they would say, I would take that all day long, twice on Sunday, right?
Yeah.
I mean, of course. But what we see is that, let's say that we have 25 new patients. Let's say you have associate, and each one of them, on average, are seeing 25 new patients a month. That can become a problem too, because, sometimes associates, sometimes hygienists, it can be kind of a transient environment, like if they're not getting fed, if they're not hitting their financial goals, if they're not able to take home what they want to pay off the big student debt that they have, then they're going to start looking elsewhere. So, or could potentially look elsewhere, right? So, it's the contrary. I mean, if you hit these numbers, then nothing in life is certain, but my gut is you're going to have a pretty good practice and you're going to have a portfolio leader in a group. If you're short on any of them, then you're probably going to be in, an average practice. And if you are short on all three, then you're probably going to be one that, is a decent practice, that because most dental practice can still make money, but there's so much upside that if you just spend a little bit of time trying to fix those three, then you could improve results probably pretty quickly. So again, most clients come in and there's certain things that are broken, there's certain things that are working. Very rarely do you see someone come in and everything is broken. But the good thing is if we're not hitting any of these metrics, then at least there's an area of focus we can try to figure out where do we need to put our attention going forward, and that's where good financial metrics in a P&L with a good operator, you can start really creating great focus and start trying to change things if you're not performing the way you should.
Yeah, you said exactly what I was going to say. What the power of these series of exercises we're going to go through does is pinpoints issues that you need to create an area of focus around to try to fix.
Yeah.
So that if you do fix them, everything else becomes better.
Yeah.
It's so easy to be like, man, my it could probably start with, man, my dental practice it's just not as profitable as what it should be.
Yep.
And kind of go through this question. Well, is it a production issue? I don't know. Okay, well, yeah, there's a production issue. Okay, go fix production.
Yeah.
What does that mean, right?
Yeah.
That's why going one more layer to find, okay, if I try to fix this in production, if I improve this aspect of it, it should fix production.
Yeah.
It's so hard to just fix production. You got to fix certain areas of production to make the overall thing better.
I mean,
that's the power of this exercise.
And that's what we say, Jared, is that the business of dentistry is simple. I said that last time, probably offended everybody, but it's not easy. We get that. And this side is tough. I mean, it's sometimes you have low-hanging fruit that you can change pretty quickly. Other times it's going to take a lot of work. Turning around a hygiene department's not easy. And there's probably going to be a lot of ruffled feathers and you may have turnover. But if you can fix it, then a lot of times, like we were talking about this morning, you can have a win-win where you can have a very high-functioning hygiene department just killing it, and they can make great money. And when they're there, they're working and they're able to provide for their family very well. So, again, I think these are just exercises that people can kind of walk through with their numbers. I don't want to speak out of school here, but I think we'll have a scorecard at the end of this where they can, download and just fill your numbers in and just see, here's the goals. Here's where you want to be. You want to be 5K per dot, 1,500, so on and so forth. Plug your numbers in and let's see how we shake out. And if we're off, then that creates an area of focus. And it's always better to at least have something you're working towards than to just be kind of blind and just rolling along. So hopefully, this is a helpful exercise to people to understand how we look at production, how we teach our team to look at production, um, and kind of see where we're at and see what we need to do going forward.
Yeah, makes perfect sense. And you're right. If you guys are, filling this out and you have questions like, you guys said this, but I don't understand it. Just message us, ping us,
Yeah.
whatever. We're here to help everybody if we can. So just, the goal is to have these, I say 6 numbers written down on a list, right? Production per operatory per month. Same thing with doctor production, hygiene production down to the month, or I guess day on the doctor side
Yep.
and hygiene side. And then kind of getting into this, the new patients, open time, and the last one, case acceptance. So if you can have those 6 numbers written down, compare them up to what we went through, kind of see where you fall, where you are, and what you need to improve upon. And again, if you have questions, let us know. We're here to help. So anything else, Bill, on the production side you can think through? Do I have a production issue? So
Yep. Yeah.
yeah,
Next time we're going to be talking about how that translates to most P&Ls, unless you're on maybe an accrual basis. Let's talk through now that we know we're good on production. We'll come to, am I getting paid for my production? Because that's really what ultimately matters.
that's right. All right, Bill, onward and upward, man.
You got it. See you next time.
We'll see you, buddy.